Hi dreamers, recently I did a dedicated video on SPYI, which is a new income fund that I've added to my portfolio. And as you can see, it's a monthly payer with a distribution yield of about 12% and an expense ratio of about 0.68%. And as you probably know, I have a certain percentage of my portfolio that's dedicated to income generation purely. And if you want to watch that dedicated video for SPYI, I'll put it up at the top of this video right here. But today I want to talk about another high-income NEOS fund, and it's the sister fund to SPYI. And that fund is QQQI. It's also a monthly payer with an expense ratio of 0.68 and a little bit of a higher distribution yield at 14.28. So let's dive into QQQI and the reasons why I'm adding it into my portfolio. So one of the things to point out here is that this fund just started at the end of January of this year, 1/30/2024. And so because of that, it only has about 116 million in AUM, or assets under management, as opposed to its big sister SPYI, which started in August of 2022 and now has over $1 billion in assets under management. And the reason why I wanted to point that out is that the financial and investing structure of what they have done with SPYI is essentially a carbon copy of what they're doing with QQQI. And my prediction in another year or so is that QQQI could easily have over $1 billion in AUM themselves, because the bottom line is that this approach seems to work well. And so going back to QQQI, let's take a look at what that is. Essentially, the fund seeks to distribute high monthly income generated from investing across the NASDAQ 100 index and then implementing a data-driven call option strategy. The fund seeks to take advantage of tax loss harvesting opportunities, in addition to using NDX index options classified as Section 1256 contracts, which are subject to lower taxes. They use a call option strategy that could include both sold and purchased NDX index options, which provide some opportunity for upside in a rising equity market. And so let's take a look at what that means for QQQI. Essentially here you can see their top 10 holdings of Microsoft, Apple, Nvidia, Amazon, Meta, Avgo, Google, Tesla, Costco. And if you click on the total holdings, you can see the full holdings here, which is essentially the NASDAQ 100 in exactly the weights that they are on the NASDAQ. But just so you know, what they're actually doing is using NDX, which you can see the price here, and doing a little bit of advanced call option strategies against the NDX. And one of the reasons why they pick the NDX index is because of that favorable tax treatment, where 60% will be treated as long-term capital gains and only 40% as short-term capital gains, simply because it's against this index instead of individual stocks. And so what does that mean for me and potentially you is that just like SPYI, QQQI might have some tax benefits if you happen to hold this outside of your retirement accounts, perhaps in an individual brokerage account. So let's take a quick look at their prospectus to understand a little bit more about their option strategies. And so as we get into the meat of this, you can see they describe it as an actively managed ETF that uses a call option strategy that consists of written sold call options on the NDX. The fund does a couple of things. It first seeks to generate high monthly income from the premiums earned from the NDX call options, in addition to the dividends received from the fund's equity holdings. In addition, under certain circumstances, they might enter a call spread strategy, where it purchases long bought calls in addition to the written sold call options. I think one of the things that I like about their strategy is that their call options are out of the money, whereas some other competitors like QYLD have automatic call options that are at the money. And I'll explain the difference between those two in a moment. And here's where they talk about that Section 1256 contract, where it just talks about the fact that the taxes are treated as 60% long-term gains and 40% short-term gains, regardless of how long those contracts were held, which is definitely a tax advantage of QQQI over others like, say, FEPI. And this is another part of their strategy that I'm a fan of, and it's exactly the same as SPYI, that under normal circumstances, about 80% of the fund's net assets will be invested in securities or derivative instruments linked to securities. And in other articles I've read from the NEOS team, they talk about the fact that their typical calls are 6 to 7 weeks out, approximately 1.5 to 4.5% above the current price as the strike price, that they ladder their options so they can roll them forward if needed, and they do this on approximately 70 to 80% of the portfolio, leaving about 30 to 20% open to capture any additional upside if the market goes up. Now, I wanted to show you a graph that I created in Seeking Alpha with a competitive set that I think makes sense for QQQI. And I've included the sister fund of SPYI just for comparison's sake. And so one of the challenges or the cons of QQQI is that it's just so new, and so there's not a lot of data out. And of course, we've had a lot of ups and downs, with the NASDAQ in particular. But here's a chart just for the last few months, ever since QQQI launched. And you can see the relative performance against FEPI, which was negative 83%, QQQ at 0.5%, QYLD at 1.3%, and so JEPQ is the clear winner, followed by QYLD and QQQI, if we're simply looking at NASDAQ-based derivative funds. Now, of course, the best returns would be if you just bought QQQ and you wrote your own call options. But for a lot of folks, that's time-consuming, requires some skill and effort and research. And so a lot of times that's not really an option. And there's been a lot of conversation about FEPI as a potential competitor to QQQI. What's interesting about FEPI, if you look into it, is that their holdings are much more curated, kind of like how Devo is a very curated form of SPYI. And so if you look at just the holdings of FEPI, you can actually see it's focused on just 15 that are right here: Micron, Google, Avgo, Tesla, Intel, Amazon, etc. And if you look at what FEPI is doing for its very high yield of above 20%, bordering 25% yield, is that they are using what's called flex options, which are call option contracts that are actually negotiated. And this is a very complex, much more advanced, and potentially risky approach, not just because of the high focus on just those 15 companies, but also because of the particular approach that they're using. Because as you can see here, flex options allow both the buyer and seller to customize contract terms to their liking. And so there's a lot of moving parts and, quite frankly, less transparency to this approach. And as you know, I'm a pretty conservative income investor, and that's really what's held me back from going after FEPI. So I'm going to give this one a lot more time to play out. But going back to my competitive set, I wanted to point out the difference between QYLD and QQQI, and why I'm choosing QQQI over QYLD. And for that, I'm going to use this example of Microsoft's call option chain. So what QYLD does is that they sell a call option at the money. And so, for example, you can see here, Microsoft price is 407.59. So they would sell, for example, a call option at 407.5, right at the money, at the strike price that the price is at currently, which would certainly give them the highest premium. And that's how they're generating the income that they give off every month for QYLD. The problem is, in a rising market, if Microsoft went up to 410 or even 412, you would get the premium at the money, but you'd forego any additional rise in the stock price. Whereas with QQQI, what they're doing is selecting a strike area that's much higher and out of the money in order to get the premium, the increase in price, and also the dividend by not selling the security. And long-term call strategies have shown that because the market has historically gone up over time, that having an out-of-the-money covered call strategy gives you a higher total return over time. So just to summarize, some of the things I like about QQQI is that their products are very focused on covered calls, and they seem to be covered call specialists because these are pretty boutique products in the market. I like it because it gives complete exposure to the NASDAQ 100 instead of just focusing on 10 or 15 individual stocks like FEPI. I also like it because it's a standard covered call strategy, and although they have some sophistication with some of those spreads, they're taking a little bit of a conservative approach with using out-of-the-money calls instead of at the money, and only writing it on 70 to 80% of the portfolio at any given time. I also like their goal of providing consistent income, and you can see their distributions so far have held up that promise with 0.58, 0.60, 0.59, which is similar to what they've done with SPYI, attempting to keep the distributions and therefore your monthly income nice and even every single month. So that's a benefit. I also like the tax-efficient approach, and that enables me to hold this in my individual account. I also recently saw an interview with the NEOS management team, and they talked about what would happen in the event of a crash. The answer was that, in a way, it could be a hedge against a crash, because while stocks go down, volatility goes up. And with a call option strategy, when volatility is up, income goes up, which can negate the downward trend. So those are some of the reasons why I'll be adding QQQI into my mix. Now, some of you might say, well, Dream, the expense ratio is much higher than JEPQ. And to that I would say, so is the distribution yield. So you have to take into account the total distribution that you're getting relative to risk. And so I'll say this like I would say in any video. These are actively managed funds that certainly come with some risk. So make sure you're not going to be putting your whole portfolio into a QQQI return. The way I'm thinking about it is more like another way to diversify my approach and add a little bit of professionally managed call options that I don't have to babysit, while I'm doing some of that on my own as well. So I hope you found that helpful in terms of considering this brand new fund, QQQI. Let me know what you think in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.